U.S. jobs report. 73,000 added in July. Unemployment rises. Imagine waking up to the news that the U.S. economy added a mere 73,000 jobs in July, a figure that not only fell short of expectations, but also prompted significant downward revisions for previous months. This revelation has sparked concerns about the health of the U.S. labor market, especially as President Donald Trump intensifies tariff measures. But here's where it gets controversial. The Bureau of Labor Statistics reported that job growth for July was a seasonally adjusted 73,000, which, while higher than June's 14,000, still lagged behind the Dow Jones estimate of 100,000. The revisions for June and May were even more alarming, with a combined reduction of 258,000 jobs from previously reported figures. June's total was slashed from 147,000 to 73,000, and May's count plummeted from 125,000 to just 19,000. The unemployment rate also ticked up to 4.2%, aligning with forecasts. Stock market futures and Treasury yields took a hit following the news, reflecting. Heather Long, chief economist at Navy Federal Credit Union, described the report as a game changer, indicating a rapid deterioration in the labor market. This weak report, coupled with dramatic revisions, could push the Federal Reserve to lower interest rates at their September meeting. Futures traders have already increased the odds of a rate cut to 75.5%, up from 40% the previous day. Luke Tilley, chief economist at Wilmington Trust, attributes the slowdown to firms adapting to a new cost structure, which has led to a hiring freeze. The July jobs report showed few bright spots, with healthcare leading the way by adding 55,000 jobs, followed by social assistance with 18,000. Retail and financial sectors also saw gains, but federal government employment continued to decline, down 12,000 for the month and 84,000 since January. Professional and business services lost 14,000 jobs. Atlanta Fed President Raphael Bostic cautions that the slowdown's persistence could lead to more troubling economic conditions. He emphasized the need to monitor the situation closely before the Fed's September meeting. On wages, average hourly earnings increased by 0.3%, meeting estimates, but the yearly gain of 3.9% was slightly higher than expected. The Household Survey, which compiles the unemployment rate, showed a decline of 260,000 workers, with the participation rate dropping to 62.2%, the lowest since November 2022. A broader unemployment indicator, including discouraged workers and part-time workers, rose to 7.9%, its highest since March. Long-term unemployment also increased, with the average duration of unemployment jumping to 24.1 weeks, the highest since April 2022. The number of those out of work for more than 27 weeks climbed to 1.82 million, the most since December 2021, accounting for about 1/4 of all unemployed individuals. Gerd Doyle, North America Regional President at Manpower Group, noted that while the labor market is not in crisis, hiring momentum is softening, and pressures are building. The report raises questions about firms' willingness to hire amid ongoing trade negotiations and escalating tariffs. President Trump has been vocal about his desire for the Fed to lower interest rates aggressively, but the central bank has so far held its key borrowing level in place. White House officials attribute shifts in the job picture to uncertainty over tariff negotiations and the administration's border policies. Stephen Mirren, chair of the Council of Economic Advisers, acknowledged the report's less-than-ideal elements, but highlighted powerful policies in place to boost the economy. Trump's frustration with the Fed's inaction was evident in a series of posts on Truth Social, where he called for the Federal Open Market Committee to overrule Chair Jerome Powell. Despite these concerns, top-line economic numbers remain robust. Gross domestic product increased at a 3% annualized pace in the second quarter, better than expected. though largely due to the unwinding of a huge import buildup ahead of Trump's April 2nd tariff announcement. Underlying demand numbers were mostly weak, and consumer spending, while up from the first quarter, remained tepid. And this is the part most people miss. The economic landscape is complex, and the future of the labor market hinges on a delicate balance of factors. What do you think? Will the Federal Reserve's actions be enough to stabilize the economy? Or are we on the brink of a more significant downturn? Share your thoughts in the comments below. Trump's economy in crisis. Jobs report fallout, market chaos. The economic outlook for President Trump's administration faced significant turbulence this past Friday, after fresh labor market data revealed troubling signs. The July employment report indicated that over the course of the last 3 months, the economy had added only 106,000 new jobs, a figure that falls far short of expectations and points to deeper underlying issues. This disappointing number is causing concern among analysts and policymakers alike, as it hints at a slowdown in the labor market, which may be more severe than earlier believed. The report, issued by the Bureau of Labor Statistics, BLS, suggests that the U.S. economy and workforce are not performing as robustly as previously thought. This evidence raises important questions about the impact of the administration's tariff policies. Do they hinder businesses from hiring more workers? The combination of weak jobs growth coupled with rising inflation further fuels fears that a state of stagflation, where unemployment climbs alongside increasing prices, may be taking hold. In response to this sobering data, President Trump reacted with visible fury. He dismissed BLS Commissioner Erica McIntyre by firing her, alleging, without providing concrete proof, that she had politicized reports before last year's election. His move raised eyebrows and cast doubt on whether future labor data would be trusted to be completely impartial, given the potential for political influence. Markets responded to the grim news with a sharp downturn, experiencing their worst day since May. Stock indices tumbled, Dow Jones dropping 542 points, 1.2%, S&P 500 falling by 1.6%, and the Nasdaq Composite declining by 2.3%. During this turbulent week, Trump also criticized the jobs report on social media, claiming it was manipulated to make Republicans and himself look bad, and expressing a desire for an honest person to oversee the BLS. The July jobs growth of 73,000 was significantly below the approximately 100,000 forecasted by economists. Even more striking were the downward revisions of previous months' data. June's figures were cut from an initial 147,000 to just 14,000, and May's from 144,000 to only 19,000. These adjustments collectively reduced the total jobs added in those months by a staggering 258,000. The Labor Department explained that such large revisions are unusual, attributing them to newly available information regarding employment levels, especially within state and local government education sectors. Economists and financial experts reacted with concern over the political moves and the data revisions. Harvard economist Jason Furman, who once led Obama's Council of Economic Advisors, emphasized the importance of reliable data, warning that political interference could undermine confidence in official statistics, a foundational pillar of economic stability. Meanwhile, White House officials acknowledged the poor figures but attributed some of the decline to seasonal adjustment quirks, with one advisor noting that a significant portion of the downward revision was due to these factors. Economist Jeffrey Frankel pointed out that the previous strong employment figures seemed to be the anomaly, and that the revised data actually aligned more closely with an economy facing headwinds like tariffs and slowing growth. Market watchers, including senior analysts such as Mark Vicker, echoed this sentiment, suggesting that the labor market might be fundamentally weaker than previously believed. Tariffs remain a central focus in this economic saga. President Trump recently signed an executive order delayed from initial dates, to adjust tariffs on a wide range of imports, with rates now hovering around 17 to 18%. Some nations have negotiated trade agreements to lock in specific tariff levels, such as 19% for Indonesia and Thailand, and 15% for South Korea, Japan, and the EU. While others face higher levies, like Canada, 35%, and Brazil, 50%. Critics warn that these tariff policies will likely slow economic growth and raise prices for consumers, a concern supported by recent job losses in manufacturing. 11,000 jobs in July and 15,000 in June, calling into question the White House's narrative of a manufacturing revival. Former manufacturing advisor Monica Gorman pointed out that the data paints a different picture. Rather than a resurgence, we're seeing a decline. Adding to the pressure, Trump publicly criticized Federal Reserve Chair Jerome Powell, calling for the central bank to take greater control over interest rate decisions. This turbulent relationship, highlighted by the Fed's decision to keep rates unchanged amid dissenting voices, has added market jitters. Many economists now project that the Fed might cut rates sooner than expected in response to the weakening job market, with futures markets suggesting an 80% chance of a rate reduction in September. Beyond tariffs and employment figures, the economy exhibits signs of a gradual slowdown since the peak of the post-pandemic recovery, which itself was fueled by trillions in fiscal stimulus. The latest GDP figures show growth slowing to 2.9% for 2023, and just 1.2% in the first half of this year, indicating that the headwinds are intensifying. Prices are also creeping up, largely due to tariffs. June personal consumption costs rose 2.6% annually, with the Consumer Price Index increasing by 2.7%. Business leaders are voicing growing concerns that the elevated tariff levels, some at levels unseen since the Great Depression, will hamper competitiveness and raise costs for consumers. The National Foreign Trade Council warned, but enforcement of these high tariffs and ongoing uncertainty could weaken America's position in global markets. And here's the provocative thought. Are we witnessing the start of a wider economic struggle, masked by political narratives? Will the resilient economy President Trump claims to have be confirmed, or are we heading toward a more permanent slowdown, perhaps even stagflation? How will policymakers balance tariffs, interest rates, and growth in the coming months? Share your thoughts. Do you see the signs of a storm on the horizon, or is this just a temporary wobble?